I'm Peter White. Welcome to the Inside Network. Welcome to the Inside Network and another edition of INDepth. I'm Peter White and my guest today is Bob Desmond, Portfolio Manager at Claremont Global. A new name on the block, but not a new strategy. Bob, welcome.
Hi, Peter.
You've got broad experience as an asset manager and you've been in Zimbabwe, Africa, Australia, the UK. How has this background informed how you manage stocks and pick investments?
Yeah, good question, Peter. I guess I growing up in Zimbabwe. It was a fairly uncertain environment for investing, you could say. I think in 1996 we were probably the best performing stock market in the world, and I think we even made the cover of The Economist that year, which is normally the kiss of death, and then it was pretty much all downhill from there till when I left in 2001, and we had hyperinflation and land invasions and all sorts of things. And I guess starting off like that, it really built in me a conviction that to survive through tough times, it's so much easier if you own quality. If you just own good businesses, you don't have to forecast what economies are going to do or what outcomes you expect to be. So right from the word go, I guess I was thrust into really uncertain economies and markets, and so I always focused on quality. And then when I moved, I have a good habit of moving when things tend to change. I moved to the UK and I landed in the UK on 9/11, and then I started working for my then employer, and the market had just fallen 50%, and it was uncertain times again. And again, Peter Silern is a very storied investor in London, and he had a real focus on quality businesses, owning them for the long term, taking the macro out of it. And he kind of drilled that into me, the importance of owning quality. And then when I started here in Australia, again, I moved just after the GFC, another perfect timing event. I think Lehman's was just about to collapse. And again, it was all around just focusing on things you could control, buying quality businesses for the long term. And I guess that's always just been part of my ethos of managing money, is just it's so much easier. It's so hard to predict economies, markets, interest rates, central banks, politics, etc. It's so much easier actually to predict companies and durable companies and what they're likely to look like in 5 to 10 years.
So in fact, you were toughened up early and often.
I guess it probably was. Yeah, in Zimbabwe I was. If you'd owned poor companies, they literally just went broke. They just went out of business. So you really, really had to be in the best of the best, the highest margins, the best pricing power, the strongest cash flow, the strongest balance sheets, best management teams. And so, yeah, right from the word go, you own quality.
You recently announced you are rebranding your strategy to Claremont Global. Can you explain why this action and what does Claremont Global mean to investors now?
Sure. Well, the strategy itself is actually over a decade long now, but the focus has been predominantly internal for our own clients. And we're now moving to a much more external focus and taking the strategy external. And hence we wanted to rebrand it and gave it the brand name Claremont. And there's a story behind that which I can go into if you want.
Please, I'm interested.
So originally the name was going to be Jolimont, which was where our heritage was, the first suburb of where we were. But Jolimont wasn't really appropriate because Jolimont Global is actually a mining services company, and there's one thing we don't do is mining, so that was particularly inappropriate name.
Reeks of footy in the MCG
so we couldn't have Jolimont. And then I thought, well, I'm from Zimbabwe, so I thought of the idea Montclair, which is one of my favorite places in Zimbabwe. It's in the Eastern Highlands and has a beautiful golf course, which I always managed to not do very well on, but had a nice time playing. But then when I Googled Montclair, it actually said it had become a casino. So I thought that's probably not very appropriate either. So we came around to Claremont, and Claremont means clear vision, or clear mountain, if you like. We have a clear vision, it's transparent. It's also interesting in that Claremont is actually a common place in all the members of the team. So there's a Claremont in Cape Town where Andrew's from. There's a Claremont in Australia. I actually went to university in Australia in Perth. There's a Claremont in England where our head of distribution's from. But we couldn't find a Claremont in Mexico where Chris is from, but we found there is a Claremont in New Mexico. So there was a Claremont attached to all members of the team.
Now this strategy has been going for at least 10 years. What's the most powerful influence or theme that you've seen in the investing landscape over the last 10 years?
I try not to talk about trends in markets, if you like. I mean, I think the thing that I would talk about in our portfolio is trends in business. And I think the one, from my viewpoint, that's probably even over the last 20 years that is incredible has been, if you like, the demise of, not the demise, but the slowly fall from grace of big consumer brand names, mass retail, mass media. So if I looked at a portfolio that I'd held, say, 10 to 15 years ago, that probably would have been 40% in consumer names. Big names like Gillette, Procter, Colgate, Tesco, Woolies, all of these big names, Time Warner. There was this sort of allegiance between big media, big brands, and retail, and that's kind of fallen by the wayside. And if I look at our portfolio today, you could say maybe Diageo is a big brand name, but it's very much at the luxury end. And that's all to do with the advent of Amazon and online and digital and how those businesses' moats have moved along. And that's been quite a really big business change I've seen over the last decade.
Now, you describe yourselves as high conviction. What does that mean? And does that always mean high concentration as well?
Well, it's a high conviction that we have a portfolio of 10 to 15 names. By mandate, we can't own more than 15 names. So that's pretty high conviction.
It's high concentration?
It's very high concentration. So the way I try and explain it to clients is try and think as the whole portfolio, as we own every single stock in the portfolio. Don't rent a market or don't trade a stock. Own the businesses that are in the portfolio. Because if you actually look at what we own in the portfolio, there's some of the best businesses in the world. They're not particularly exciting, some of them. The portfolios on average age is over 80 years old. The oldest dates back to 1866, but they're very, very durable, all-weather, resilient businesses. And if you can own those, you can actually compound your wealth over long periods of times owning those. We're quite happy to not own, we don't own banks, we don't own oil and gas, we don't own resources, we don't own insurance, we don't own utilities, we don't own large parts of healthcare. So we just believe in owning really high quality businesses that are durable, well managed, and we hold them for long periods of time.
What are the rules of thumb, should I say, in terms of making your portfolio, given what an elite small group it is of stocks?
Well, I guess the first thing is you have to be really, really durable. So the first thing we'll look at is we'll just go, the best protocol, we'll go to the financial crisis and just look at how did you go through the financial crisis, because that was a pretty acid economic test. And if you got into any form of trouble there, you had to repair your balance sheet, you had to cut the dividend, you had to have an emergency capital raising. That's pretty much a big red flag for us. That's the first thing. And the second thing is we want businesses that earn good returns on capital through an economic cycle. So I can think of so many businesses, and let's face it, most people get into markets when markets are going well. They tend to think that the good times will keep, they can't envisage that things will get worse. We are going through one of those periods at the moment, which is bizarre given where we were this time a year ago. But think of the example of banks in the financial crisis. I mean, they would have gone bankrupt if it hadn't been for governments and shareholders. Think of airlines through COVID. We just stay well away from those types of industries, which are great in the good times. Everyone's making lots of money, and then in the bad times, we have to recapitalize, go to the shareholders or the government. We just stay away from things like that. So if we can find businesses that are durable, as I said, through the tough times, then we know they'll be fine in the good times, and that really is what we're looking for.
And that also infers that you have low turnover of stocks. Once you've found something good that you like, you hold it for a long time. Is that correct or not?
It can be. To be honest, the turnover of the fund's actually been higher than I would have historically than I would have preferred, and that is really driven by fluctuations in the market. Our ideal holding period, I think Warren Buffett says, is forever. But obviously, if a stock becomes overpriced, we will replace it with something that's equally as attractive but at a better price. Or sometimes businesses just lose their competitive advantage, and if that happens, we'll sell out of a business immediately. And we think, okay, the story's changed, the business has lost, it's not what we thought it was, we've made a mistake. And you have to do that. If you're running a 10 to 15 stock portfolio, there's no room for passengers.
Just for instance, what's been the turnover, say, in the last 12 months?
Last 12 months, we've got 14 stocks in the portfolio, and we've added 5 new names, so third. Give it a third, yeah.
You're a signatory to the UN Responsible Investing Code. How does that adoption of ESG principles inform how you manage stocks and how you manage the investment process?
We're not looking to tick a whole lot of boxes, if you like, in terms of carbon footprint or emissions or things like that. What we're really looking for are businesses that have a culture that is long-termist in thinking. And I mentioned earlier that our businesses have been around, on average over 80 years old. So you don't get to that sort of position unless you've got long-term thinking. So if I think of something like something we own at the moment, Sherwin-Williams. So yes, they're very good in terms of reducing their footprint, reducing waste, reducing emissions, sustainable energy, all those sort of things. But it's more than that. It's built into the governance of that company. You can see their employee turnover is really low. Like their voluntary employee turnover is 7%, which is pretty much unheralded in terms of a retail company. Their management turnover is incredibly low. The CEO's been there for 36 years. So people don't stay at companies where they get treated badly. So they obviously, you can see there's a metric there where they treat their employees really well. You can tell when you talk to their suppliers or people who've worked there that they really, really care about their customers, who are essentially professional painters. When you read their transcripts, you can see they really care about their employees and making it a good place to work. And you can see they always rank highly in the best places to work in terms of diversity, all those other things. And then the last piece of the puzzle, you can actually see it actually in how they pay themselves. I think that is such a crucial part of ESG is metrics and how companies get paid and the incentives and all of that, how that pulls back into it. I don't think it's just about ticking boxes. For example, the CEO at Sherwin-Williams, when COVID hit, he just took his bonus was just cut in half. He went to the board and said, just cut my bonus in half. He kind of put himself forward. And I think it's all those key metrics, then pulling them all together. And then you can actually look at how that stock's delivered. I think it's over time, it's at 42 years of successive dividend increases. It's consistently ranked number one in customer satisfaction surveys. It's consistently ranked in employee rankings. So you can kind of see it's across the whole board that they delivered to all their communities, not just to the shareholders.
So companies like run by, say, Elon Musk or Jack Welch or Steve Jobs, they mightn't have ever figured in your thinking.
Definitely not Jack Welch, I don't think. I think there was a lot of, easy with hindsight, but definitely a lot of just make the numbers and forget about the rest of it. Obviously geared up the company, lots of acquisitions and various things. I don't know about Steve Jobs. I think he was obsessed by customers, there's no doubt, and doing the right thing for customers. Who's your last one? Musk. Musk would be a tough one. I'm fairly lukewarm on Elon. I'm 50-50. I wouldn't just buy. There's lots of other things you have to admire him for.
I guess my point is they don't seem to always treat people as well as they may or could or should.
I think that's such a big part of actually buying a good business is the culture. And if you just treat your customers well and treat your employees well and treat your shareholders well, I think that's a really good place to start.
So if there's one key trait to assess when you're looking at investing, a prospective investment, can you name that?
I think it would probably be cost of value. So the ideal company for one is where you're a really small part of that customer's costs, but you're essential to the value proposition. For example, the example I'd like to give is a company we've owned in the past, we don't own at the moment, is Sika, which is a construction and chemicals business. They are literally only 1 to 4% of the total build cost of a building, let's say. But they are so crucial to the structural integrity of that building. It could be in the cement, it could be in the fluents, it could be in the sealants, it could be in the waterproofing. And they are sold white coat to white coat, so it's really a highly technical sale. To us, that's an ideal business to be in because when the tough times hit, you can't cut costs there. And even if you do try and cut costs, it's such a small part of the cost proposition anyway. You're not going to save much, but you're putting your whole value proposition at risk. So the one thing that I think of is how easy is it to just turn you off, or how easy is it to switch to an alternative supplier?
Finally, what's your outlook for the markets, the international markets going forward? Are you optimistic, pessimistic, or is that a naive question?
We try not to think in markets, to be honest, Peter. I would say on balance, if I look at our portfolio, it's probably trades in line with where it has historically. I do think markets are high. I would say markets are on the full side. And for what it's worth, even though we don't look at markets, obviously interest rates have driven markets to, you could argue, to fully priced levels. And so our focus is always to focus on the business. and always assume at the back of the mind that something bad will happen over the next 3 to 5 years, and then just build in that resilience I spoke about at the beginning. Good balance sheets, good margins, good cash flow, good management, fair prices, because I do think we're on the other side of that equation you've just outlined.
Bob, thanks very much for talking to us today.
Thanks, Peter.